Hi there, this is Matt Kerfman here from Richmond Brothers with a late April edition of Matt's Minutes. Thank you very much for tuning in. Just wanted to get a couple of notes and thoughts out there. In the last month or so, quite frankly, not a lot's changed. There's still a wall of worry out there, and most broad benchmarks are still in negative territory year to date. And we've talked and hinted at some of the reasons, but one is the Federal Reserve started raising the short-term interest rate in March. Two is we're all experiencing a higher than normal or higher than average inflation period. So we're really feeling that really in the price of fuel, getting gas for our vehicles, and also more so probably in the grocery store with prices of food. In addition, the conflict with Russia having invaded Ukraine is still ongoing. And then there are hints of what you call yield curve inversion. And so those are really the four things that we see out there causing a little bit of the wall of worry. So a couple of just calming reminders, or I hope to be calming reminders. One, Federal Reserve is generally going to raise the short-term rate when the underlying economic conditions are improving. We have been at near zero rates for a really long time. So it still feels like the broad market and the psychology of how investors are experiencing things right now are really dealing with the kind of initial shock of raising rates. And so one of the best ways to put an analogy to this, if you think about like a 30-year mortgage rate, in the last year, you might have been able to get a 30-year mortgage for your home at maybe around 3%. And there's data that now suggests a 30-year mortgage is 5%, which is a big percentage increase. But for many of you who might have had a mortgage or a land contract back in the late 70s and well into the 80s, you probably recall you could have had a mortgage at 10, 12, 15, even 16%. Those were really, really high interest rates. We don't know for sure if that's what's unfolding. We don't think so. We think there's a lot of supply chain issues still coming out of the COVID-19 and just the pandemic, supply chain related issues that haven't worked themselves out yet. Also, I do want to remind you historically, research from Guggenheim Investments goes back in time and really strongly suggests that there is not a single exception to what I'm about to say in history. Anytime the Federal Reserve has started raising rates, which they did last month in March, the following year the markets have been the best investment class to own, so equities. Additionally, if you go back in time, research suggests that in a higher than normal inflation environment, which we are certainly experiencing, the best asset class to own is equities. In the moment, that doesn't feel so good because that's really what's on the downward trend in 2022. But we wanted to kind of put that data out there. There is certainly the wall of worry with respect to Russia and Ukraine and the ongoing conflict over there as well. And that's just adding, when we speak specifically to money in the markets, adding to kind of that fear index, which is enhancing and increasing volatility and really big market swings. So we just want to kind of let you know what we see going on through the volatility. Not a lot has changed in the last month. There's still the same 3, 4, 5 circumstances that are causing the worry. And we just want to kind of remind you to kind of go back to your risk score as you talk with your advisor. Just make sure we're continuing to revisit that risk score. We're trying to send it in advance of any of your calls or meetings just so you can see it. And as a refresher, that scale of risk is from a 1 to 99. The closer you are to 1, the safer and more stable your portfolio is. The closer to 99, the more volatile, more aggressive your portfolio is. If you had everything in the broad market, such as the S&P 500 or maybe the NASDAQ, that would currently represent about a risk 75 or 76, just to help give you all some context. So again, if you end up in the scale where your risk score is currently 30, 35, or 40, that's significantly less risk than if you had all of your money in the market. And so what brings that risk down is owning maybe more safe assets. For example, some of you may own stable fixed equity indexed annuities, which generally are going to be in that risk 1 category. You may own some low duration bonds, which could be in the risk 10 to 20 or 25 category. Now, that doesn't mean those asset classes are perfect, but they generally carry significantly less volatility than the broad-based market. So having a diversified portfolio right now is real important. And although it feels like we could be tipping into recession if you read the headlines in the news, there's a lot of data suggests that that just isn't the case. And so we just wanted to let you know we are watching, we are paying attention, we are here for you. Our aim and our goal is to help educate you, to help inform you, and to help guide you through any of these environments that we're experiencing. So as always, if you have any questions, please feel free to respond to this video or just write us at questions@richmondbrothers.com, and I will be back in early May with another update for Matt's Minutes. Thank you so much for tuning in, and thank you for being part of our Richmond Brothers family.